So here's a fact for 2024 real estate investors. It's just tough to go out there and find cash flowing rentals in today's higher interest rate market. Now, just because it's tough doesn't mean it's impossible. So in this video, I'm gonna talk about 3 trends and then go through 3 deal analyses to show you how we're finding cash flow in high interest rates like 7-8% in 2024. Now, as we go through this, we're doing something really unique. We're looking at both as a house hacker and a landlord investor. There's great opportunities in both, so we're looking at it through multiple lenses so you can find the best strategy and the best deal for you in 2024. My name is Chris Lopez, and I live in Denver, Colorado. Now, I'm an investor, I'm a realtor, I'm a podcaster, and through all of that, I'm a part of hundreds of deals and hundreds of conversations. So I get to see all sorts of data and all sorts of deals. That means what's working and what's not working. So before we jump into 3 deals, I have to pause for a second. And I need you to stop and hit the reset button. The strategies that used to work in low interest rate environment, they don't work in today's market. You have to pivot into what's working. So I've seen so many investors where they're stuck in the old strategies. That market is over. We're in a new market and you have to reorient how you're finding deals and what type of deals you're doing. And that's exactly what we're doing in today's video. Now, the deals I'm talking about today are real deals that I've worked with here in Denver, Colorado. Now, don't get focused on just the market or the numbers for our local market underwriting. Really focus on the trends and the opportunities out there, because that's when you can go out there and translate to your marketplace. So let's dive into it. Trend number 1, the Airbnb short-term rental growth wave is over. Now, throughout the last 10 years, Airbnb's just been on a giant growth curve from, more people adding properties to the rents going up to all these services. And a lot of people have built some great portfolios off of Airbnb. Now, it's not crashing. It's just that hyper growth is over and we're seeing some pullback right now. I'm seeing a lot of investors, both here locally and across the country, seeing between 5 to 15% in lower revenue. Some markets are being hit harder than others, but overall, the trend is that revenue is down. The second trend I'm seeing is that the bottom portion of Airbnb properties, they're being taken off the market. I've talked to numerous Airbnb property managers where they're saying, hey, about 10 to 15% of the bottom of our portfolio, this is no longer working. We have to phase out. We can no longer get the bookings. Identifying the trend is what allows us to go out there and find the deal. So what are short-term rental investors pivoting to? Many are pivoting to medium-term rentals. So think about 2 to 4 months rentals. So that's more than the 30-day short-term rental and less than the long-term 6 to 12-month lease. So a lot of times they're renting out to traveling nurses, digital nomads, people who are relocating, or people on long-term work assignments. Now, a lot of short-term investors are pivoting to medium-term rentals because they already have everything in place. The furnishings, the pictures, all the procedures, all the processes, they're already in place. So it's a relatively easy pivot. Now, while we're seeing short-term rental revenue come down, we've been seeing medium-term revenue go up. In addition, it's actually a lot easier to self-manage. So a lot of these short-term rental landlords are starting to fire their short-term property managers and then go self-manage their medium-term rentals. Because with a medium-term rental, you often have like 3 to 6 turns a year. So we are talking a fraction of what you have as a short-term rental property manager. It's kind of the sweet spot right now for like revenue and also time into the process to self-manage. Now let's dive into the deal. So this is a deal that we helped the client close on at the end of 2023. And it's a single family home, 3 bedroom, 1 bath with an ADU, accessory dwelling unit, 2 bed, 1 bath. So basically 2 houses on the same property. So another reason this property makes a great medium-term rental is the location. It's convenient to several major highways and big intersections. It's also 1 block away from a light rail stop, and it's about a 12-minute drive to downtown Denver. So now we're going to dive into the numbers. Now I've got this property and all of our properties plugged into the rental property calculator on BiggerPockets breathtakingly.com. So come get the links in the show notes and come underwrite these properties yourself. So we're going to look at this medium-term rental first through the lens of a house hacker, because that is who actually bought the property, is a house hacking investor. Now, this house hacker bought it with an owner-occupied loan, but used a special grant program, which helped them to really minimize down payment, plus have no PMI or monthly mortgage insurance, which definitely helps out with cash flow. So the property was $555,000 and got it an interest rate at 7% on the 30-year fixed. Now, we got all numbers plugged into here for the expenses, the rents. You can come in here and look at all these numbers yourself. I've got pretty realistic and conservative underwriting in here, but of course, you come check it out yourself. So how much does this property cash flow? It'll cash flow about $330 a month. Now, this is once the house hacker moves out. I'm not going to go into details for what they make while living there. My point of view is when you buy a house hack, you're buying a future rental. So when this is all said and done and the house hacker moves out, you should be cash flowing about $300 a month, which is about a 10.5% cash on cash return. Now let's shift gears and talk about the same property, but rather than buying as a house hacker with a low 0 to 5% down payment, we're going to buy it as a landlord who's going to put down 20 to 25%. So all the numbers are exactly the same on the property. I've just changed two variables, which is the down payment amount and the loan amount. So the property still costs $555,000. We have the same operating expenses, same rental income, but now the investor is putting down 20%, which is about $125,000 all in, and rather than a 7% rate, at about an 8% interest rate. So 1 point higher than the owner-occupant house hacker loan. With that said, this property will cash flow about $580 a month. Now I'll make a note here on this property and all the other properties I'm underwriting is I have management fees set to 0%. Now, as I mentioned earlier in this video, a lot of the opportunities we're seeing are for investors who are hands-on operators. And to help with cash flow, the vast majority of investors I'm seeing, they are self-managing their property. Why? Well, when you add in an 8 or 10% property management fee, it just really hurts cash flow and oftentimes puts it into negative territory. So part of the ways that investors are going out there and adding value and cash flowing is by operating themselves and creating very efficient processes and using technology to streamline their property management process. All right, so let's wrap up deal one. Now to highlight it, as a house hacker, you'll be like $20,000 to $30,000 all in, and it'll cash flow about $330 a month. Now as a landlord with a 20% down payment, we're looking at like $600 a month in cash flow. Which one would you choose? Let me know in the comments. Trend number two is finding light to medium value add residential multifamily properties. Duplexes, triplexes, fourplexes. Now, when I talk about value add and multifamily, a lot of people think about the BRRRR strategy. Buy, rehab, rent, refinance, repeat. It's a great strategy, but it's incredibly tough to do in this market cycle where prices have stayed high and rates have gotten really high. It's just really hard to make those numbers work by increasing value. So I am not talking about a BRRRR. I'm talking about focus on opportunities to increase the cash flow. Now, there's really two types of deals I'm seeing a lot of. One is legacy landlords. So think landlords that have owned the property for 15, 20 years plus. So they've owned the property. A lot of times it's paid off or close to a zero loan balance. A lot of times now the property has just been outdated for 10, 20 years and severely under market rent. The other type of landlord who's selling right now is like the distressed or really overloaded, tired landlord. Now, these aren't the ones that have owned for decades. These are people that bought the last couple years and they have a full-time job and they just have a hard time operating the property and they just can't make it work. So they're looking to sell and just move on from real estate. So now that we've identified the trend, let's jump into deal number two. Now, this is a fourplex, a real fourplex here in northern Denver that we closed recently. And seller was a legacy landlord. So pretty simple business plan for this fourplex. Buy the property, go do light cosmetic rehabs, about $6,000 per unit, and then bring rents up to market rent. Now, when our client bought the fourplex, 3 of the units were at $1,200 a month in rent, and one unit is at $750 a month in rent. Now, market rent is about $2,200 per unit. So obviously a very big gap on there. Now, for our pro forma underwriting, which is what we expect to achieve in rents, we went 10% below market rent. So we went from $2,200 to about $1,980. I'm a big believer, and it's always best to plan conservatively. If numbers work then, awesome, you got a really good deal. Another note on the business plan here is part of the contract, we negotiated maximum seller concessions and then used the majority of that money for a new roof. So that did two things for the investor. It took out a big capital expenditure and also was a significant insurance savings. Now, a lot of markets are seeing big increases in insurance, and in Colorado, a lot of it has to do with the age of the roof. So our client was able to save more cash in rehabbing the property, plus save annual expenses for many years to come by having a lower insurance premium due to a newer roof. And the money left over was rolled into helping reduce closing costs. So let's jump back over to the BiggerPockets rental calculator to dive into the numbers. So this fourplex was a purchase price of about $800,000. Now we're going to first look at it through the eyes of a landlord investor. So the minimum down payment is 25% down for a 30-year fixed conventional. So $800,000 purchase price, about $200,000 down, and we're getting an 8% interest rate. Now, with that down payment, and then once we have the property up to rehab and up to market rent about $1,980 a month, or about $8,000 a month total, it's going to cash flow about $1,300 a month. So a pretty strong cash flowing deal and an 8% interest rate. Now, a couple other things I'm seeing on here that I would highly recommend you come over here and play with this on the BiggerPockets calculator is a lot of investors are putting down a 30 or 35% down payment for more of a buffer. So you can come over here and slide this over and do a 35% down payment and see what it does to monthly cash flow. Now, what I like to look at, I'm gonna put this back to 25%, because what happens if we are able to hit our market rent of about $2,200 a month and increase the rent by about $1,000 a month? Well, now our cash flow increases quite a bit. So a really cool feature about the BiggerPockets calculator is to come play with these slider bars. Again, all the links to all 6 analyses are in the YouTube show notes. Go click on them, hop over to BiggerPockets.com and go create an account so you can play with these yourself. So let's shift gears here and look at this fourplex through the eyes of a house hacker. Now, again, this was a real deal we did here in Denver. And what's really cool about this for house hackers and multifamily is a change happened in the conventional loan space at the end of 2023, where now they allow a 5% down payment for an owner-occupant triplex and fourplex. Now, before this, you could really only buy multifamilies with a VA loan, so you have to serve in our military, or with an FHA loan. Now, a big hiccup for FHA was the self-sufficiency test, which often did not make the numbers work for a triplex or fourplex, and therefore you couldn't get an FHA loan unless you put down like 20%. That defeats the purpose of house hacking. But with this new 5% down underwriting rule, it's opened up a lot of opportunities. So this property actually went to a 5% down house hacker. I think it was the first or one of the first deals in Denver using this new loan. So same numbers here in terms of operating expenses, but all we changed was the loan structure. So rather than a 25% down payment, we did a 5% down payment, and then we dropped the interest rate from an 8% to a 6.5% interest rate. Yes, that's the real number. Now, one notable thing on here is we did add in PMI, which is private mortgage insurance, and they are not cheap on these 5% down loans. But even with this minimal down payment, look at the cash flow on here, $300 a month. Now, that's not gigantic cash to retire off of, but for a fourplex with, minimal money down, the fact that you can cash flow is a great opportunity for so many house hackers out there. Now, again, if you want to go play with these numbers, go click the link in the show notes and hop over to this report on BiggerPockets.com. So for this light value add fourplex, as a house hacker, it would cash flow about $300 a month. As a landlord investor, about $1,300 a month. Again, let me know in the YouTube comments, which one would you choose? So let's talk about trend number 3. Now, as you probably know, there is just a lack of affordable housing across the country. And because of that, we've seen a big demand in room-by-room rentals. So a lot of times we're going out there and finding a 4-bed, 3-bath, single-family home that's a large property and has the opportunity to add 1, 2, or 3 additional bedrooms. Might be with a garage conversion, might be with adding a few bedrooms to the basement. But we're often able to add a bedroom anywhere from about $1,000 to $7,000 per bedroom. And this has a significant bump in cash flow. So if you decide to do a room-by-room rental, consider doing a theme-based room-by-room rental. My clients who do this are often getting a rent premium. So here are some examples. So we have a large teaching hospital in Denver, and a lot of our clients have created room-by-room rentals geared towards residency students. So, these are doctors in training working 80, 100-hour shifts a week, and their schedule's all over the place. And I hear they want 3 things. They want multiple refrigerators, they want blackout shades, and they want air conditioning. So they tailor the property to that, and then they get residency students in there. I've also seen a lot of theme-based ones around coders or tech workers. They want amenities of really high-speed internet, Wi-Fi, other features like that. So again, I just want to give you the idea out there, because if you're in one of these niches, you probably have some insight on how you can make a great property for this type of tenant. So now that we've discussed the trend, let's jump into a real deal. One thing you need to know before you do a room-by-room rental is make sure you check the occupancy limits on where the property is located. Now, the reason we like this deal is, first, there's great value add potential. It was a 5-bedroom house, and we could easily add 3 more bedrooms to it. Secondly, it had ample parking, because when you have more beds, you have more heads, you have more cars that need a place to park. So this is a corner lot with lots of street parking and also a big driveway. So parking is a great thing to keep in mind as you're looking at doing room-by-room rentals. Let's jump over to the BiggerPockets calculator and look at this room by room. First, we'll look at it through the lens of a house hacker. Now, our client who purchased this property for $520,000 used a down payment assistance program. Now, what that means is he was all at the closing table for closing costs and down payment for just under $3,000. Yes, for less than $3,000. So it's about $3,000 and $11,000 in repair costs to add those 3 bedrooms. So $520,000 purchase price at a 7% interest rate. So again, we're looking at these numbers for once the house hacker moves out, not while living there. But once he moves out and has all 8 bedrooms rented, it should be a gross rental income of about $6,400 a month. Subtract out all the expenses, and we're just shy of $600 a month in cash flow. Not too bad for $3,000 down and a bunch of sweat equity. All right, now let's pivot over and look at the same deal, but do it through the eyes of a landlord investor. So again, all the exact same property details. The 2 variables we're changing is the down payment amount and the interest rate. So rather than a $3,000 down, we're looking at 20% down, which is about $125,000. And now we bumped up the rate to 8%. Income expenses all stayed the same. And now this property is cash flowing just under $1,200 a month. So for this room-by-room rental, the house hacker will cash flow about $600 a month, and the landlord just under $1,200 a month. Now look at the cash-on-cash return though, because the cash-on-cash return for the house hacker is almost 50%. Why? Well, it's because he put so little money down. Now, while the landlord's making more cash flow, his cash-on-cash return is a measly 11%. But this is the power of leverage and why you need to look at, hey, this is a great way to operate the property and which way do I want to structure the financing around it? Because if you have the ability to go out there and house hack right now, I highly recommend you do it. So let's take a step back and look at all 6 analyses side by side. Now, I want to kind of bucket this into 2 opportunities. There are investors who have, a lot of time, but no money or little money. And then the other end of the spectrum is investors with money, but no time. So this creates a really great opportunity in the marketplace for partnership potential. Because as you can see here, all 6 of these deals cash flow. Now, in the reality, very few landlord investors are going to put down $100,000 or $200,000 into a property to go self-manage an 8-bedroom room-by-room rental. They have the capital to go buy, but they don't have the time to go operate it. So this is where the potential comes in. So I've actually had quite a few clients end up partnering together where we've got the investor with money be the money equity partner in the deal, and then the investor with time come and do the sweat equity operations. And then guess what? They both get cash flow and they both get a win towards their real estate goals. So let me know in the comments below which type of deal you would be doing, which were you most attracted to, medium-term rental, value-add multifamily, or a room-by-room rental, and which category you fall into. Are you an investor with capital but no time, or an investor with no capital and lots of time? So use this opportunity to clarify your goals, and who knows what? You may go out there, find a partner, and do a deal.